House values could drop by up to 7% in Sydney and 8% in Melbourne.
We're seeing national housing stabilisation and in some aspects decline, more significant in Sydney and Melbourne.
And is this just the knock-on effect of, some of these big policy changes, a lot of negative sentiment out there?
Investor lending made up about 41% of the activity pre-budget. It's now down to about 22, 23%.
Melbourne has a 54,000 dwelling surplus. Sydney has a 29,000 dwelling surplus.
A great analogy was, who wants to catch a falling knife? No one. First home buyers, they don't want to be going out there now and buying a property for $1 million that could be worth 900 in 2 or 3 months' time.
My question to you is the two-speed economy now starting to catch up?
The reason is because there is a different supply equation playing out in our key markets across the country. No one's talking about the supply story.
You're listening to the Follio Property Podcast. I'm Reece Bettle, and I'm here each week with my co-host Lachlan Delahunty. Lachlan, you're on holiday at the moment, but you've made the effort to still talk property. I know your finger's been on the pulse with the property market in Australia over the last week, even though you've been away. A lot to unpack that's happened in the last week, so I thought today we'd go through a bit of a deep dive in what the markets are saying, talk a bit more on this two-speed economy that we've been mentioning quite a bit on, and actually delve more into some key indicators that we track as a business and really affect sort of, property movements, and looking at that demand and supply indicator.
Yeah, Reece, massive couple of weeks. It's amazing how quickly things can move, and there's just so much noise. We talk about a lot on the podcast, obviously, but good to unpack the data as to why we're seeing what we're seeing across Australia, particularly that two-speed. Today we're going to unpack, I think, exactly as the why these markets in Melbourne and Sydney are falling a lot faster than we're seeing in Perth, Brisbane and Adelaide. So it'd be good to dive into those figures.
Hey guys, quick thing to share. If you're serious about investing in Australian property right now, you need to see what we put together. It's called the National Investment Report, and it's our brand new monthly deep dive into exactly where the market is moving, what the data is saying, and what the smart investors are looking at right now. And you can get the first access completely free. Just scan the QR code on the screen right now or click in the link below to fill out the form. Yeah, look, slight positive this week. We've been speaking on the podcast the last month or so where we're seeing auction clearance rates at record lows for Sydney particular, and Melbourne also, well below where they were 12 months ago. Interesting to come out this week, clearance rates were actually almost a rebound. The 7-week high, still well below where they need to be from a market perspective. But what do you make of the weekly data there? Is there any improvement, or is it from an auctions reported standpoint that there's probably not enough data to really see that there's going to be any change on that?
The auction clearance rates did improve. The weekly median house prices, which we'll unpack, did not for Melbourne and Sydney. They had a pretty steep fall in house prices. But what's interesting is, obviously on a Monday, Reece, we do a call around the grounds to key agents, sample size of about 10 agents in each market to get a feel. And that's really important, because data's one thing, but if you can overlay that with home open activity, how many people put offers in, how many people attended inspections, we noticed this week there was definitely an uptick across Australia. Obviously, markets within markets. Perth was back to really high levels of activity, so some of that was being seen in Brisbane as well. Certainly Melbourne, the busiest it's been at home opens for a good probably 10 weeks. So there's signs that very small green shoots coming through to see that people are now well on the other side of the budget, generally more interested in property than they were 3 or 4 weeks ago.
And is this just the knock-on effect of, some of these big policy changes, a lot of negative sentiment out there? Is this just the knock-on effect of people starting to understand where everything stands and looking for that next opportunity? And classic thing we always hear, it's, the right time to invest is when you're ready, essentially. But are we seeing this being a bit of a knock-on effect from the negative sentiment start to improve, or is there actually, some green shoots or some positive stories out there that's affecting this potentially for affecting some change?
Yeah, I was listening to a podcast with Tim Lawless, the Chief Economist with Cotality, and he was almost somewhat confused that why there's been such a fall in the market, predominantly around there's been a lot of drawback on investor lending post this budget. We know as to why. Investor lending made up about 41% of the activity pre-budget. It's now down to about 22, 23%. So we've seen a massive drop-off in investment activity from the lending side, which then correlates into activity on the ground. What people are more surprised about is the withdrawal of A, first home buyers, and B, own occupiers. People are confused that, well, the budget had no impact on those markets. In fact, the budget was introduced to encourage first home buyers. Why is the entire market, particularly those two demographics, pulled out? And it comes back to it, and I hate repeating it, Reece, it's sentiment. Does it, as a first home buyer or an owner occupier, a great analogy was, who wants to catch a falling knife? No one, particularly first home buyers that are vulnerable to sentiment, vulnerable to noise, headline media. They don't want to be going out there now and buying a property for $1 million that could be worth 900 in 2 or 3 months' time. So we've seen a retraction of probably what the opposite of what the Treasury wanted. I think the biggest withdrawal of the market has been from that, the first home buyer market, which will surprise a lot of people.
We've been talking about this all year, about the two-speed economy. And for those that are listening for the first time, when we say two-speed, it's Melbourne and Sydney running at one speed, and Brisbane, Adelaide and Perth all running at some significant growth. We're now seeing, looking at the data that we've seen from a week-by-week basis, you've got Adelaide with 3 weeks consecutive negative growth, Brisbane negative growth for consecutive weeks as well. Perth still positive growth perspective, so 0.01% per week, so not as much as what the highs we've been seeing, but that's still 0.5% growth per month if they continue that trajectory. My question to you is the two-speed economy now starting to catch up? Are we essentially got 5-speed economy at the moment with different markets, or where do you see particularly areas like Brisbane and Adelaide, which are now starting to hit its affordability caps and start to have a bit of a downturn?
Yeah, we're seeing a national downturn in property prices, albeit some are falling at a greater rate than others. And you look back in history, Reece, we take this data way back to the 80s. There's never been any sub-market perform at the same speed, same rate as another sub-market. So there's always going to be different speeds of rises and falls. But what we're seeing now for the first time in pretty well back until the Royal Commission in 2017, 2018, we're seeing national housing stabilisation and in some aspects declines. And obviously that decline is more significant in Sydney and Melbourne. But yeah, it is interesting to see the resilience of a market like Perth. And I know we get a lot of comments that everyone thinks we are so pro-Perth. We're not. We're very independent when it comes to the data. But we'll go through some supply stats today, which probably underpins why a market like Perth continues to grow, probably the toughest market conditions in terms of macro factors that we've seen since the Royal Commission. So the supply data is really what I believe is underpinning the difference in performance between the markets like Melbourne and Sydney compared to a market like Perth and or Brisbane.
Let's delve into that. That you mentioned there the supply and demand factors and particularly why Perth is remaining strong on that front. I know you and our Chief Economist have been working on this paper over the last couple of months just to try to understand where the supply and demand balance is for each capital city and to particularly see, is there an oversupply in each market? Are we at a neutral or is it undersupplied? And I just want to read through some of these figures, and it might back up in terms of what we're seeing in terms of the market conditions from a property growth perspective. But Melbourne...
Sorry, before you jump into that, Reece, I think what's important, and when we did this paper, what we're seeing at the moment is all the headlines, all the, call them experts in our industry, are only talking about the demand side of the equation. And the reason they do that, it's because it's the easiest data to pull, right? Auction clearance rates, it's a direct correlation to demand. How many people participated at auction, how many people purchased. Median house price, you could argue that is a supply and demand equation, but people are reporting solely on demand indicators. And we know property prices are built around 3 fundamentals, well, really 4. Demand, supply, affordability, confidence. They are the 4 key fundamentals. And supply is equally as important as demand. And no one's talking about the supply story. Everyone is calling out that we have a national shortage in houses across Australia. And we've been the most undersupplied market that we are in history. Well, that's factually incorrect. And you're going to go through the numbers here. The reason we have such a 2-speed economy now isn't because of the demand, isn't because necessarily interest rates. It's because there is a different supply equation playing out in our key markets across the country.
Looking at the data sets you mentioned there as well, so just to kind of, for those that are listening, we'll have some graphs up here for those that want to view it as well. But looking since March 2022, so we're looking in the last 4 years, looking at the data that yourself and the Chief Economist Ryan Bridie had a look through, Melbourne has a 54,000 dwelling surplus. Sydney has a 29,000 dwelling surplus. Adelaide, a market you said was, we've already seen start to come off this year out of the 2-speed economy, that has 10,400 dwelling surplus. And then on the other side of the spectrum, you've got Brisbane, which is the market that just kept going on a run over the last few years, has a shortfall of 16,600. And no surprises, Perth, you would have heard our commentary over the last 6 months, but the stat is actually pretty damning. Perth, 32,800 dwelling shortfall in Australia. So the largest in Australia and double Brisbane in terms of what Brisbane shortfall. So talk to me through those stats, Lachlan. Was that a surprise to you once you saw those figures? If so, how do we look to fix some of these problems or the demand imbalance across each capital city?
This tells the story, Reece, why we're seeing this two-speed economy. You compare Melbourne to Perth there. What was Melbourne's figures in terms of surplus? And this is over the last 4 years, correct? From 2022 until now?
Correct.
In terms of how many, and for those listening or looking at the data that we're showing, what it calculates is how many people are moving into any particular macro economy, or city, be that Melbourne or Sydney, assuming, and some key assumptions, that it takes 2.5 people per household on average. That's the national averages. How many houses we need to build to keep up with the demand of the migration, be that interstate or overseas. So it's a really good understanding of, are we building enough houses or are we building too many? And when you look at Melbourne over the last 4 years, everyone's calling that we have a national shortage in houses, right? That has been the headline media. We are not building enough houses for the migration. Well, it's factually incorrect, because if you look at Melbourne, what was the shortfall?
54,000 surplus, I should say.
Surplus, sorry. With Melbourne, they've built 54,000 more houses than was required for the population coming into Melbourne. And you compare it to Perth, which the shortfall was
32,800.
There you go. So you put 85,000 difference in terms of a market that's, one is overachieving in terms of housing supply and one is significantly underachieving. That is your difference between a market that is falling by 2% a month in terms of house prices and another one that's been able to stabilise and in fact increase house prices by 0.75 per month in what has been, economically quite a tumultuous period, as we know. So that supply story is super interesting. And then you talk about the resilience of a market like Brisbane also being in significant undersupply. And this is not a small sample size. This is over the last 4 years, post-COVID. So it tells a damning story. And I think when you look at the resilience of a market and why markets are holding strong, Brisbane and be that Perth, it's because simply, regardless of macro economy or macro headlines or what's happening with policy, interest rates or tax, if you're in a market where there is a significant shortage of supply, where demand significantly outweighs supply, the market will continue to perform in terms of medium house growth. And I think we're seeing that play out, and it's why there's such a dramatic difference between our two major markets in Melbourne and Sydney and that of, say, Brisbane and Perth.
Let's just single out Melbourne, for example, there as well. So the data that we're tracking and from our latest weekly update from our Chief Economist as well, Melbourne is becoming a two-speed economy itself within its own market in terms of the affordable inner city, particular units or apartments potentially as well, performing well in terms of the auctions and the sale prices and starting to see some growth where you're actually seeing some negative growth on the outer burbs. I'd imagine a lot of those 54,000 surplus stock is going to be in those outer fringes as well. So is that probably another indicator on why we're seeing that sort of two-speed economy in an area like Melbourne where the oversupply is probably more on the fringe or further out from the inner city ring?
Yeah, you just have to go onto realestate.com to see how many house and land packages are available in Melbourne, right? They've got, the thing with Melbourne, it's now our biggest city, and the reason why is it's not bounded really by, if you look at Sydney, you've got obviously ocean and mountain ranges. You look at Perth, it's bounded by water and a national park or areas where you can't bring on supply. If you look at Melbourne, besides obviously the ocean side, it's uncapped in terms of the urban sprawl. You can build, as far as the eye can see in the north and the same in the west and certainly out to the east as well. So it's always been a sprawling city. And you compare that to Perth, the two biggest markets in terms of over and under supply. Perth has a significant shortage of land available to build on, right? There's very little. You go on realestate.com and speaking to our builder associates, there is no land. They can't build anywhere because there's no available titled land to build on. If you go to Melbourne, it's the opposite problem. There's thousands and thousands of lots available. They can't give them away. So yes, there is a massive two-speed economy within Melbourne itself where there's an oversupply or an overbuilding that's occurred on the outer fringes, and we talk about our concerns in that house and land space because there's an abundance of it. There is no scarcity. But then if you go into the inner city of Melbourne, you talk about those units, there is an undersupply because the building costs have gone up so significantly, particularly for multi-unit apartments. The feasibilities haven't stacked up. They haven't been building that stock now for well over 5 years. There is that two-speeder market where the house and land package space, there's an oversupply. For that multi-unit sort of lower density stock, there's a significant undersupply. And that's probably why you see more resilience in that particular portion of the market in comparison to what you're seeing in the outer rings.
Looking at Adelaide as well, so Adelaide had a surplus as well of 10,400 dwellings in that period as well. So not as extreme as Melbourne, a third of where Sydney's at. We're now seeing Adelaide, obviously it's hit its historical affordability ceiling. You predicted at the start of the year that Adelaide would be coming off this year and probably see little to no growth after the first quarter of the year, which so far looks like you're on track for. Is this oversupply now once you hit an affordability ceiling, is that where the oversupply is really going to start to slow that price growth and in some cases maybe even go stagnant and backwards?
Yeah, definitely. You would have seen an uptick, and that's what we've seen in Adelaide because there is ability to bring on supply. It's not as capped as a market, say, as Perth at the moment in terms of that supply chain. You've got an affordability issue and you've got an interstate migration issue. Obviously, we know overseas migration has slowed down. There's a lot of pressure put on the government. So across the country, we have seen certainly not a decline. We are letting a lot of people still into this country, but it's not at the same rate as it was 18 months ago. So now Adelaide is getting less overseas migration. We know over the long term, it can struggle with interstate migration. So it's now losing more people than it's gaining. And you've got an affordability ceiling and supply, right? Developers are making good money in Adelaide because prices have gone on a run over the last 6 years. So there's more houses coming out of the ground. There's more house and land packages going to get sold. That's a market that I think will see the median house decline intensify over the next three to 6 months.
Looking around the grounds then, we speak about this quite a bit on the podcast where we're talking about our sentiment index. So you mentioned there's the 4 key indicators that you're going to look at from a property growth perspective: demand, supply, affordability, and you said confidence of it, essentially sentiment. Looking at our sentiment index that we track here at Follio, and this is like a large sample size, I must repeat. So there's over 2,000 people fill out this sentiment index. Confidence by state. You'd be surprised, hearing that data there. Obviously, you mentioned the two-speed economy. Melbourne, obviously severely oversupplied, is having negative growth. But from a confidence perspective, Melbourne has the highest confidence out of every state in the country right now in terms of investing. So just to give people context, it'll be on the screen, but 6.2, and the next best is 5.6, which is WA. So clearly a front runner there, and people in Victoria now are starting to have some bit of confidence in the market. Any reason to why that would be off the back of seeing some of that negative growth and a lot of negative press in the media at the moment?
I think twofold. There's obviously an affordability attraction with Melbourne now, and that's, from an investment point of view, we know people like to invest at lower price points, and now really the entry level to a market like Brisbane or Perth is north of $1 million. Compare that to Melbourne, where you're still getting quality assets, as little as sort of 450, Reece. We've seen that in our space. So there's that affordability play, which makes more sense. There's also the cash flow. Interest rates now are historically still cheap, but over the sort of medium to short term, quite high. So yield becomes a huge factor. And obviously Melbourne rents have increased significantly over the last 5 years, but prices haven't making the yield. So the cost of your rent against your holding costs is now getting, up to 5% gross, which compare that to markets like Brisbane, Reece, where it's, in some instances getting sub 3% gross. It makes it very difficult as an investor to hold that property, particularly without any negative gearing benefit up front. So I think we're seeing naturally there's an affordability attraction to Melbourne, but the yield in terms of the cash flow to hold the property makes more sense. And I think I would overlay that, with genuine commentary as well, Reece. Obviously, we speak very fondly and positive around the Melbourne market, medium to long term, and even in the short term, we see now some really good green shoots in sub-markets, certainly not broadly speaking, but there's positive growth in sub-markets. And I think you listen to, other podcasts or area experts, Melbourne is sort of the market of choice for a lot of those commentators that understand how markets work in terms of supply and demand, but also the sheer migration Melbourne's receiving, the highest population growth in the country, supports that demand side of the equation. We probably just want to see less homes getting built, which we are starting to see in the more recent data, Reece, and generally confidence. And I think leading up to a November election, we could see a pretty large shake-up in Victoria, which would potentially, there's talks of a reduction in property tax, land tax, which would be massive for that market that's suffered huge policy issues and tax issues over the last sort of 5 years.
The other fascinating thing to come out of the latest sentiment index was regarding the type of investor. So we talk about this. We do have first-time investors. We've got your mum and dad, which we classify kind of as one property, but your more experienced or sophisticated investors with 2+ properties. Last month's recorded data is actually the strongest confidence they've had all year. So even before, start of the year, before we started seeing a lot of these rate rises, the Iran war, the negative sentiment, the budget changes as well, we're now starting to see, you mentioned there, interest rates or serviceability is probably affecting investors getting in the market, whereas a lot of these experienced investors were never utilising negative gearing to begin with, and now starting to see a good opportunity. Does that surprise you that we're now, looking at the latest data, it's the most confident experienced investors have been this year?
So we're now 2 months post-budget, Reece. So like anything, it takes time for people to understand the implications of a massive tax reform like that. It sort of only got passed a couple of weeks ago in terms of the fine print, and they're still winding things up and changing the goalposts. So once people have certainty, whether that's positive and or negative, certainty creates confidence. And I think we're seeing that in the data. What I'm more interested in, Reece, is a lot of people have a lot of opinions around what's going to happen over the next 3 months, 6 months and 12 months in terms of house prices. I believe the best indication, the best short indicator of house price movement or activity on the ground is sentiment. There's no better statistics. And if we correlate our sentiment data over the last 6 months in terms of our clients are feeling about the market, and then look at the data over the 3 to 6 weeks following that data being recorded, it's a very strong correlation. What I mean by that, when there's negative sentiment from the numbers we track, it's typically followed by 4 to 6 weeks of uncertainty or market decline. When there's positive sentiment, it's interesting. It's a smaller sample size, but it's obviously a reflection of the general public. We see positive market data. So what that tells me, Reece, is that we will see more activity at home opens over the next 3 to 6 weeks based on that sentiment data, and we'll likely see higher auction clearance rates and or lower days on market, and we may start to see a stagnation in house prices across Australia. I don't think we're going to see insignificant increases in markets like Melbourne and Sydney. I think we'll continue to see that in Perth and potentially in Brisbane, but I certainly think that sentiment data is a really good indicator of what's going to happen over the next sort of 4 to 6 weeks.
Let's go around the grounds, and we've mentioned some of this data already, but let's actually do a bit of a deep dive in each capital city to wrap up the podcast today. Looking at Sydney, weekly values dropped 0.3% this week. Median values still sitting around the 1.23 mil. The 4-week moving average is 0.33%, so the lowest of 2026. I mentioned earlier that there was obviously a slight uptick in clearance rates, the highest in 7 weeks across those Sydney and Melbourne. However, 53% this week, so above 50, but looking at last year, it was 75%, so still well below. Although it has ticked up into the 50s, it's still well below where it was sort of 12 months ago. Where do you see this going for the next couple of months? Are we in this same neutral territory? Do you think it's going to get worse? Will this week's data be a sign that the tide is turning?
Reece, again, looking at correlations, I love correlations, but if we overlay, and it'd be good to show our listeners, when you overlay the auction clearance rates with weekly house price movements, we know that anything under 55% auction clearance rates results in negative house price movements. So until that improves, and yes, it's improved slightly, until we see that ideally north of 60%, that market's going to continue to fall.
Looking at Melbourne, weekly price decline of 0.31%, so very similar to Sydney. Big thing though is, Melbourne's median value is now below 800,000, 794,000, which, looking at the rest of the country and those capital cities, there's some tremendous amount of value there at the moment. Clearance rates sitting at 54%, not as a significant drop as what Sydney saw 12 months ago. So 12 months ago was at 66%. We mentioned earlier in the podcast, it very much is a two-speed economy where, inner areas like Brighton, Hawthorn, Elwood, St Kilda are starting to see a lot of value, and we're hearing that on the ground from our agents in the area where things are moving quickly, whereas, areas out in the wild west, as we say, like your Meltons, your Werribes, Tarnees of the world, are starting to slow down from a movements perspective.
I think, again, those auction clearance rates, we know the correlation there. Absolutely echoing that Melbourne in itself is largely at a two-speed play. And that's reflective, obviously, in the data that we track from the quartile data, but obviously looking at, and when you talk about those blue chip inner east suburbs, understand that's more in the affordable price points, probably more in the unit space than it is in the luxury home space. We know that market's probably the hardest hit market in Australia. That north of $3 million in Melbourne is still getting it's still getting smashed in terms of house price movement. And that may take some time to improve, and it may be in the back of a change of government before we see that sort of higher end blue chip $3 million plus price range start to improve in any sort of significant levels.
Looking at Perth, we mentioned there, actually had growth last week, 0.11%. Medium dwelling value now well over $1 million in Perth at 1.026. The sales to listing ratio, so obviously Perth isn't an auction-driven market. You'll hear us talk, through the podcast regarding listings versus sales, and particularly the ratio. It's around 11 to 12%, which, in the highs where we were seeing 2% growth was kind of sitting around that 35% mark. We've also seen listings above 6,300, which is probably double where we've been sitting for the last 12 months. They're probably some key indicators to show you that it is, although still growth and still ongoing, it is starting to slow down in Perth as well.
Interesting about Perth, it's the only market this year that hasn't experienced negative house price movements. So, and we know why. We just spoke about that because of the supply and demand imbalance. But that is showing this sheer resilience to that market. And what I think will play out now for the rest of the year, I do believe the worst is behind us in terms of that confidence story. I think we'll start to see Perth return to that 1% growth per month as a minimum. So you're looking at about 0.25% growth a week to achieve that, which is still significant growth, well above its long-term average.
With Perth, one of the only, literally from this week, the only capital city experiencing some growth. The medium house price obviously ticking well over $1 million now. So from an affordability factor, Perth might not be the right fit for a lot of investors out there. Where do you still see value in Perth in terms of asset types? And is there any particular suburbs that you still see maybe are undervalued or do have potential for some uplift in the next sort of 12, 18 months?
Perth still will surprise a lot of people, has an affordability runway, Reece, and that's because the incomes in Western Australia are just so much higher than they are in the rest of the country. Where do I see the opportunity? Would need another podcast to unpack this. Obviously, there was a huge announcement last week that there's a change in the R codes, which for those that don't understand R codes, that's essentially the policy that underpins how you can and what you can subdivide. And it's essentially going to open up to 10,000 dwellings that are a single title, being that you can't subdivide. They're going to be able to potentially become duplex or triplex. So I think there's going to be a huge run on those subdivide, currently zoned that you can't subdivide, but in 12 months' time, we'll be able to subdivide. Those development sites will become a potential place for a lot of Western Australian people to park their money. I think there's going to be a huge flight to those assets, and we know that the higher price points, the established properties are performing very well for finished product.
For those that are interested in us doing a deep dive on that, please put some feedback in the comments as well, because I think it's a brilliant episode we should unpack in a couple of weeks. Looking at Brisbane, we mentioned there actually starting to see some negative growth back-to-back now. Weekly price growth, pretty significant, to be fair, 0.2% negative growth last week. 4-week moving average has actually turned negative for the first time this year. And I dare say, not having the historical data in front of me, probably the first time in a good few years, I'd say they've seen some negative growth. Auction clearance rates at 23%, although there isn't a lot of auctions there, so you kind of take that with a pinch of salt. Particular corridors like Ipswich and Logan and Caboolture are starting to see some buyer demand fade in those areas as well. Do you see, we mentioned earlier, the big thing on the supply was, Queensland or Brisbane is still severely undersupplied. Do you see this being a bit of more of a neutralisation, or is there still some runway to go, or is it actually, it's hit its affordability ceiling and now we're starting to see some negative growth for the back end of the year?
Probably echo Josh Coleman's comments, and if anyone wants to listen to our Queensland episode, he covers that off quite well, that you're going to start to see Queensland as a whole open up into probably 3 to 5 different market speeds throughout. And I do think across the board, I think it will be more of a stabilisation. I don't think we'll see Brisbane as a whole city free fall. I think your outer fringe house and land areas are going to struggle, and I think your off the plan prestige type assets that have been receiving record results over the last few years, I think you'll start to see a bit of a dry up of that as well.
And then finally, just touching on Adelaide, weekly price growth negative again, 0.06. Medium house value at 945k, so under the $1 million mark there. It feels like it's starting a quiet sort of rollover, and momentum has disappeared from the market. We mentioned earlier that there is a bit of an oversupply in Adelaide as well. When we looked at the research paper yourself and our chief economist did in the last 4 years, and also we've spoken about this on the podcast, Melbourne's hit its affordability ceiling. Do you see this kind of being a bit more of a neutral stabilisation over the back end of the year, or will we start to see some more aggressive negative growth like we've seen in markets like Melbourne and Sydney over the last couple of weeks?
Like I said, Reach, and I'm not I love Adelaide. It's a beautiful part of the world, but we've got to look through the lens of the data. And unfortunately, I think we're going to see the market decline in terms of median house price movement intensify because of that supply story, interstate migration story, and the affordability story. It's got a lot of headwinds. I think we'll see the weekly decline potentially increase over the next 3 months.
Lachlan, we've been tracking monthly, weekly data since we've launched Follio. We're getting better analysis into our weekly data as well. So we really want to start pushing more content out there for our listeners and from a more regular update. So this was kind of a bit of a taste on some of the weekly data that we're looking at, such as the supply and demand indicators we mentioned earlier in the podcast. We're going to start pushing more of this out. So if you'd like to hear more deep dives, we get a lot of comments on places we miss out as well, particularly from people from Canberra and Hobart. We will start looking into those markets as well, but please...
we've got the data there. We will start to cover them as well. Obviously, we just be mindful not to have a 50-minute podcast to do a market deep dive, but yes, that is, and Darwin will be covered as well.
Yep. So please leave your feedback in the comments. Do you like what you want to hear more of, what you liked, what you want us to do more data analysis in? But yeah, we're keen to dive more into the data that we track on a daily basis through our property portal PropStack. Start bringing some of that information to light, because looking at the paper that you recently did on the demand and supply indicators, there's a clear correlation, like as you love saying, correlation, that what property prices are doing as well. So you've been listening to the Follio Property Podcast.